Hey everybody, it is good to be here today. My name is Brent Moores and it's time to learn some more about options, long options specifically. In fact, today what I want to do is I want to talk to you about three key things that you need to know if you're going to be an option trader. Now, these apply to all option trades, regardless of the strategy you do, but specifically we're going to narrow in on long options today, that is buying calls or buying puts. We're going to do that in just a few minutes here. We're going to get to that as soon as I go through a few quick disclaimers and also just mention I have Connie Hill in the chat helping me out. And so as you have questions, feel free to type those in the chat. Also, you can follow us on X, formerly known as Twitter. My name is my handle is @BrentMooreCS. Connie's handle @ConnieHillCS. Now, we'll be talking about options today, but options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of a security chart pattern or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money application is provided for educational purposes only. All investing involves risk, including risk of loss. There's no guarantee an execution of a stop order will be at or near the stop price. Past performance of any security or strategy does not guarantee future results or success. And the paper money application does not assign short options early. Here's what I'm going to do. I'm going to head on over to the thinkorswim platform. This is what we'll be demonstrating off of today, the thinkorswim desktop platform. But the principles I'm going to talk about, doesn't matter what platform you're going to use because these are time-tested options principles. Now, one thing I do want to mention before we get too far into this, we have a lot of great guests here today. I'm glad I see some familiar names and I see some of you here are first timers. I would encourage you to subscribe to the Trader Talks channel, the Trader Talks Schwab channel, so you don't miss future content. I Googled this earlier, so I don't know whether this stat is true or not, but I saw that there's about 3.7 million video uploads to YouTube a day. So why do you subscribe? You subscribe because you're never going to find what you want probably with all these videos out there. So if you like trader content, if you like market content, make sure you click on that little subscribe button in the bottom right portion of your screen there. And so you don't miss it in the future, not just this class, but other classes there. So I mentioned there are three things that are kind of important things that you need to know that drive option prices, okay? These are the three key things. And what moves an option price? Well, let's just use a little Word doc here real quick. The movement of the stock price drives an option price. With a long call, we want that stock to go up, and that's going to help out our option. So that, and associated with that is we can measure it with an option Greek. There's different things we call option Greeks, which are just measurements of how whatever we're talking about affects an option price. How much does a move in the stock price affect an option price? That's a Greek called delta. Okay, there you go. The second big thing that we want to talk about is I'm going to talk about today is the second big thing that can affect an option price is time decay. And there's an option Greek that goes along with that, and that option Greek is theta. That measures how much the time decay of an option is going to affect that option price. Okay, and there's a third thing, and that is implied volatility. I'm just going to write down volatility here. And there's an option Greek that goes with that. I know Vega technically is not a Greek letter in the Greek alphabet, but it's an option Greek, and that's what we're going to call it there. And that is Vega. Okay. Now, for our options, let me just move this over one space here. What we're going to talk about, why is that not? Let me just move that. See if that'll move that. There we go. We're going to talk about long calls, okay? And we're going to talk about long puts. And so for our options, for our delta for long calls, our delta is positive. And all that means is if the stock goes up, if the underlying stock goes up, that's going to generally help your long calls. Okay? For long puts, what's our delta? Our delta is going to be negative. In other words, if the stock goes up, it's going to hurt your long puts. Now you go, that's a bummer. That's actually a great thing, because what that also means is if the stock goes down, that's going to help your long puts. And that gives you a way of trading the market if you're bullish on a stock. I know a lot of you are stock traders, probably have never traded an option before. And I'm going to encourage you today to use your paper money platform to practice what we're doing here. But if you want to be able to trade a stock that you think is going to go down, you may consider paper trading at least a long put to test it out, because that negative delta means that that option price will go up if the stock goes down. They go opposite directions. Okay? Time decay. Here's the not so nice thing about long options, whether you're talking about calls or puts. Your time decay is negative. In other words, every day you hold that option, it's going to work against you a little bit. Now, other stuff may do fine. You know, if the stock is going up and you have a long call, you may be making money, but you may be a little bit less than you otherwise would have because of that time decay. That's what we call negative theta. Now, I'm going to talk a little bit later in this session about some strategies to try and help minimize the negative effects of that time decay there on either long calls or long puts. But we'll get to that in just a little bit. But there's one more I want to talk about here, and that is implied volatility. Implied volatility, or Vega in this case, how does that affect your option price? It's positive. In other words, if implied volatility goes up, this is after you buy the option, if implied volatility goes up, everything else being equal, okay? In other words, we know there's some other factors in there such as stock price and time decay. But if implied volatility goes up when you have those options, whether they're long calls or long puts, it's going to tend to help out your trade, and vice versa if it goes down. Now, a lot of times where we'll see that is earnings. We've just been we're in earnings season still. We've been through probably the biggest part of it, but there's still a bunch of companies coming out with earnings. And what often you see is after a company releases its earnings, its implied volatilities go down, and that can tend to hurt your option prices there. So that's one challenging effect with that. Now, we can see this. We can see the effects of some of these, and I'm going to encourage you to try this out. I'm going to encourage you to try this out on your Thinkorswim platform here. But what I'm going to do here is I'm going to go to the Trade tab. And actually, let's look at a stock. Let's just pull up a stock here. I'm going to pull up UNH, okay? Here's United Health Group. And for my purposes here, what I'm going to say is this stock, from a technical analysis standpoint, I'm going to say we have a low, we have a higher low, we're kind of establishing a higher low and bouncing here. I'm going to call this starting to trend up here. Now, we could throw moving averages on here, but I want to keep it pretty simple here, so I'm not even going to use a moving average. And so I'm anticipating my stock is going to go up, so I'm going to look at a long call on this. Long call when we expect that stock to go up. Remember, we're going to use a long put if we expect that stock to go down. So here's an example we may look at. Now, we know that's the stock price element of it. We mentioned the time decay element of it. Time's going to pass. That's one thing we know about this. We don't know whether the stock is going to go up or down. We don't know for sure whether the implied volatility is going to go up or down. But we do know time is going to pass if we hold this several days. So theta is going to work against us. But let's consider that implied volatility. I have implied volatility graphed out here on the chart right here. Now, if you want to add this, you can add that as a study, okay? You can add that as a study. You just can go up to your studies right up there and add the study, or you can go to that little flask up there and add a study called IMP volatility, and this will graphically display it here. But what I want you to notice here is I want you to notice what implied volatility has done. It kind of goes up, and then it's pulled down. And then it went up, okay, and then it pulled down. And if you kind of look carefully, you'll see there's earnings events. Now, we're past earnings here, but that implied volatility tends to drop after earnings. And then it tends to generally, it goes up, there's ups and downs, but in general, it tends to go up after earnings. So remember, both long calls and long puts are positive vega trades. They benefit from increases in implied volatilities. Therefore, this is probably not a terrible time to consider doing a long option from the implied volatility standpoint. Now, we still need the stock to cooperate. We still want that stock to go our direction. And in this case, our direction is going to be up since we're bullish on this. And we want implied volatility to help us out on that. But let's look at this. Implied volatility, by the way, right now is about 26. And it kind of generally, the higher points in implied volatility are up closer to the level of 40 here. Let's take a look at a modeling tool we have on Thinkorswim to help you figure out what your options could potentially be worth here. So I'm going to go to the trade tab. I'm looking at United Health Group. And what I'm going to do is I'm going to look at options that are out a little bit further here. I'm going to go out 38 days. Now we can go out a little farther than that. That's no problem at all. But one thing, as we're trying to figure out how to minimize theta to a certain extent. Remember, theta is that time decay. Time decay tends to affect options that are getting closer to expiration. It's going to tend to be higher for options that are expiring in 2-3 weeks' time. So if we could buy with a little bit more time when the theta is not as high, and then look to sell with maybe 3 weeks to go before expiration, that's going to help us to avoid probably the worst of the time decay. Now, we'll still have some time decay that can affect us, no doubt. But if we're looking for ways to minimize time decay, one strategy that we can use is we can buy a little bit more time. We can buy 38 days. We can buy 50 days. We could buy 70 days. That's one way to try and minimize the time decay on there, because if you compare the time decay on these different options, in fact, let me just pull up theta real quick. If I compare my theta, there's a column right here that's theta, and I look at different options. Let's look at the theta. Let me just make this. Oh, let me get rid of this left-hand column. That'll help us see it. There we go. Let's look at the theta here on the 530 call. This is a more expensive stock. It's a $532 stock. For expiring in 3 days, 104 versus 38 days, about 25. In other words, our time decay, the rate of time decay is about a quarter right now. A quarter going out 30 days versus going out 3 days. And in general, the longer you go out, the slower that rate of time decay is going to be there. All right? Okay. Now, the question in the chat, is there a filter that shows the extrinsic value for each option contract? Yeah, you can, if you're interested. I brought up these columns here, but you can change these columns, folks, to what you want. So I encourage you to play around with it a little bit. For example, if you wanted to find out what the extrinsic value is, you can go to Option Theoreticals in Greeks and go up and display that extrinsic value right there. You can see that displayed right there on that. Okay, so there's a lot of different items on here you can look at, but that's one of them you may consider looking at there. Now, but what I want to do is show you a tool here called the Theo Price tool. With this Theo Price tool, we can see how much it is. What we can anticipate what an option contract is going to be. Now, John in the chat said, if you go out further, let's say we go out to that 38 days, it's going to be more expensive than buying out 3 days. You betcha. The farther out you go in time, the more expensive that option contract's going to be. That's fine. That is absolutely true, and that is just part of the deal there. If you're buying, because you're buying more possibility is one way to think of it. Think of it this way. Between now and 3 days from now, how far can UNH go up? Well, maybe a little bit, right? I don't know exactly how much it's going to go up, but certainly there's more potential over the next 30 days, over the next 50 days, for that stock to go more in your direction than you would if you're going shorter term. Now, there's different types of traders. We can do long-term trades. We can do leaps contracts. I've done, in fact, in this webcast occurs every week, by the way, leaps contracts, where we bought out a year or more with the expectation of holding those options for a long period of time. And they're pretty expensive options. We can do trend trades where we're expecting that stock to trend up kind of maybe indefinitely. And we may even demonstrate one of those here before we're done today. Or we could do swing trades. But generally, just if you're trying to minimize that time decay, if you're trading these with 10 days or 17 days to go to expiration, you're buying those contracts, your rate of time decay is going to be higher. Now, if you're only holding them for a couple days, may not be that big an issue. But let's look, and I want to demonstrate this using this Theoprice tool. And what I'm going to do is I'm just going to buy, I'm just going to buy in the money just a little bit. Now, here's another thing on that theta. Thetas tend to be highest when you are buying right at the money. By right at the money, I mean those contracts that are closest to the current stock price. So right now, the theta is probably going to be highest at that 530 strike price right now, because the 530 strike price is the closest one closest one to the current price. Now, let's go to that. As I go farther and farther in the money, or farther and farther out of the money, the theta is going to be less. I can go up and buy that 480 strike price, but it's going to be a little more expensive. This is a more expensive option contract. Well, it's a more expensive stock, 530. Think of how much it would be to buy 100 shares of this stock. Buying 100 shares of this stock would cost us $53,000 plus. Okay, that's a lot of money. If I were to say buy the $500 option call, it's going to cost us about $4,000 instead of $53,000. Now, am I getting the exact same movement out of that? No, because we can look at our delta. Let me just switch back one more time here and look at delta. My delta for that $500 car is about 79. That means for every dollar move in the underlying stock price, I'm getting about a 79% of that move into the option. That is why options are leveraged. That's an example of options leverage. In other words, for a $53,000 investment, if this goes up $1, we make $1. For a similar $4,000 investment, if the stock goes up $1, we make about 79 cents. We're paying less than 10% of what the option would be. Now, leverage can work for you or it can work against you. So that leverage, if we're wrong and that stock goes down, we can lose money at a leveraged rate. So you do need to be careful with that. And this is not intended for your more conservative part of your portfolio. But let's go back to that Theoprice tool here and say, hey, I'm going to get out of this at the end of the month. So I'm going to click on Theoprice. And if you've used this before, make sure you reset before you use it because it will stick the old settings here. I'm going to hold this to the end of the month. And what I'm going to do here, I'm going to compare the mark price to the Theoprice. In other words, Theo price is telling us what that option theoretically should be worth. It's not going to be exact, probably. It's just an estimate. The mark price is telling us what the current price there, okay, about the current price. So, hey, so by going, by adding in, what, the 28th, that's a couple weeks, that's about almost 3 weeks of time decay in there. You can see how much we stand to lose on that option. About 10% on the option price, roughly, based just on time passing. Just based on those time decay, the time decaying, it's not factoring in any stock movement on us. So when I say theta is working against us, theta is negative, that's what I'm talking about. Now, let's say that stock goes, let's check out the implied volatility. We said that implied volatility may go up more towards the 40% mark. So I'm going to move that implied volatility up, we'll say up about 13%. So I'm going to crank up that implied volatility 13% higher than it was. And now let's look what's happened to that Theo price. The implied volatility is actually helping us out if it were to go up. We don't know. We don't know if this is if the implied volatility is going to go up or not. But if it does, and if it went up that amount, you can see how much that option price would change on there. Now let's do one more thing. I'm going to go up and we're going to model a stock price move. I'm going to look at the last move that we went up. Last time this stock went up, it went from about here to about there. I'm going to say from about 500 to about 550. Okay, I'm just going to be real quick in this estimate. About a $50 move. Now you may say a $50 move is a very big move. Well, it's a very expensive stock, so a $50 move is certainly feasible. And I'm going to go $50 move up from the bottom, which was about 525, would give us about $575. If this option, if the underlying stock went up to $575, what would we be looking at here? Okay, and this is just an example. Okay, so I'm going to go back to my Theo price. I'm going to say the stock goes up to $575, which is about $42 above where we're at right now. So I'm going to put this up $42. Now, little hint, if you are using this tool, you can model moves down as well. In other words, if I wanted to model a $42 move down, I could do that. I would just put a little minus sign in front of it instead of a plus sign. Same thing with volatility. I could put a little minus sign in front of there. So now let's see what that option would be worth, theoretically would be worth here. For our $500 option, current mark price, $40.17 or $4,000 for the contract, goes up. That's about a 50% gain in the option. Okay, so that's about a 50% gain in the option on about a 10% gain in the underlying stock price. 10% gain in the underlying stock price, again, I'm rounding, equals in this case about a 50% gain in that option price. So my point in doing this isn't to say, hey, this is a recommendation. This is not a recommendation of this stock. It's to show you, number one, kind of how these options work, and number two, how you can use this Theo price tool. You can change your parameters there. Remember those three parameters? The stock price, the time parameter, and the implied volatility. PTV is how I remember those. Price, time, and volatility. How you can adjust those three parameters to see where your stock may be. All right. Now, if I wanted to, I could do the same thing and I could say, well, what if my stock goes down? What if we break down and I'm going to say this is kind of a support level here around 525. What if the stock goes down to, we'll say by the time we get out, the stock's at 515. How much would we have will we lose on that? Well, let's do it. Stock goes down to 515, and maybe it moves down a little quicker. So I'm going to go out a week. We'll go out to the 21st. And for the stock to go to 515, we're looking at about a $17 move, a negative $17 move. Okay. And we're going to say that implied volatility doesn't go up. In fact, we'll say that implied volatility stays right where it's at. Now, what are we looking at here on this? Now we're looking at a move from about almost $4,000 option price down to about $2,400, $2,500 option price. So use this tool. It can go for us or it can go against us, but let's show you how you could actually place that trade if you wanted to. So what I'm going to do here is I'm going to right-click on my option. I'm going to buy custom with, I'm just going to say with a stop. And bear with me here on this because you may be thinking, well, I want a bracket order. Well, we're actually going to turn this kind of into a bracket order in a sense. But make sure your quantity is what you want. I'm going to do one contract. And remember, you could lose it all. We may put in a stop price. We may think we know we're going to get out, but that option could go down very quickly and it could go down to zero, that option can. So we just need to be a little careful on that here. Okay, so there's my entry price if I wanted to get in. And I can go and I want to put a sell on here. And now I'm not actually going to make this a stop. I'm going to make this a market order. And I'm going to make that market order good till canceled. And I'm going to put in a rule to get us out. I'm going to put in a rule to get us out. So I'm going to click on this little gear over here. Now you may not see that gear. You got to put your cursor over there first to see that gear. You click on that and it's going to bring up a window. It brought it up in a different monitor for me. Let me just do this, bring this over. And what I'm going to do is I'm going to say, I want to get out of this trade if, I'm going to click right under the symbol and it's going to put in UNH, which is the stock we're looking at. We said if it marks greater than or equal to $575. This is talking about the underlying stock here. This is a condition on the underlying stock. And I'm going to go to the line right below that. And I'm going to say if it marks less than or equal to, and we said, let's see, we said, I forgot what we said. Hold on one sec. We said our support level is 525, but we're going to say, we're going to give it a little wiggle room here. We'll go down to about 515 on that. So let me go back here. Let me click back on this. And I'm going to fill this out. I'm going to say $515. 515. Now, I'm going to click on save. I'm going to click on confirm and send. And I just want to read this over. Make sure you read these over before you submit them. Here we're buying this contract, the March 25th March 21st, 2025 $500 call. We're going to sell this if, look, there's conditions tied to that second order. We're going to sell this if the underlying stock moves at or above 575 or below 515. This is an order that's exiting our options based on the underlying stock price. Now, you can do it as based on the option price as well if you wanted to. We'll show you that next in just a bit here. But we just filled that order. That's a sample trade. And I'd encourage you folks, hey, this paper money here is for you to try out, to be able to learn these strategies without risking your hard-earned money on it. And you can kind of see how, it's a simulation and see how things are going to do here on that. Now, let's do a different one. Let's look at a different stock here, different example. I'm going to pull up AMD, and here's AMD, and what's AMD doing? Well, AMD is trending down. Now, when I said, the first thing we're looking at here is the price. What's our forecast, bullish or bearish? There's certainly different ways to come up with it. And there's more than just looking at technical analysis, perhaps. But from a technical standpoint, it is a bearish trend. In other words, it has been trending down. And the assumption for most bearish traders is we'd like to see stocks that are trending down. The assumption is that the prevailing trend is going to continue. If it's an upward trend, the assumption is the upward trend is going to continue. In this case, it's a downward trend. We're going to assume that's going to continue down. Therefore, we're going to do a long put. Because remember, that long put has the negative delta on there. It benefits if that stock goes down in price. Now, we still have the time decay element on here, and our volatility is still, our vega is still positive. In other words, we benefit if that implied volatility goes up. Again, I have implied volatility on this chart where it seems like we're at a low area. Now, it certainly can go down further. There's no, this isn't a floor. The scale can change on this, but given its history, it appears more likely there's more room on the upside than there is on the downside there on that, okay? So positive vega trade may benefit for us. But this is going back to what someone mentioned earlier in this chat, and that was, what about the length? How long should you buy? What if you're doing a swing trade? If you're doing a short-term swing trade, you're probably going to buy less time. If you're doing a trend trade, and that's what I'm going to assume here, I'm going to assume this trend is going to continue. And I'm not going to get out at any particular price on the downside here. I'm just going to let it run as long as that trend continues to go down. I'm going to continue with this trade. So what I'm going to do here is I'm going to put in a long put option. I'm going to buy a little more time on it because I'm expecting this hopefully to continue trending down for a while from this perspective, from the perspective of a long put trader. And so let's do that. Let's go to the trade tab. I'm going to go out, not 3 days. I'm not even going to go out 38 days. I'm going to go out a little longer. I'm going to go out, we'll say 65 days. Okay? I'm going to go out 65 days here. Now I'm going to look on the right side of the page. I'm going to look at my puts. Now, one thing when you're doing calls or puts, double check the bid-ask spread here. In other words, here's the ask price, here's the bid price. Look at them. 610 ask, I'll just go at the 110 right now. I'll just go out the money right now. 605 bid. There's about a 5-cent difference between those. That's a nice tight bid-ask spread. Some options you'll look at and it'll say this, the ask price will be 610 and the bid price will be $5 or something like that. And just kind of as a maybe rule of thumb, general, there's different ways to do it. But what I would say is you want them to be less than 10% within 10% of each other, okay? Less than 10% of each other. Probably 5% would be even better. On a $6 option, 10% would be 60 cents. 5% would be 30 cents. In this case, ideally, I'd be within 30 cents of each other. Here, it's only 10 cents, within 10 cents of each other. So that fits the bill, so to speak, there on that. Okay, so let's look at this option here. Again, I'm going to click on the ask price if I want to buy it. I'm going to go a little bit in the money to try and hopefully reduce that theta here on this. And so we'll go up to the 120 strike. It's going to cost me a little bit more, about $1,200. Now, that is not, you certainly can go out of the money here a little bit. Sometimes there's benefits in going out of the money. In fact, last week in this very class, I talked about the differences between going in the money and at the money and out of the money. And in fact, for those of you who are interested, what I'm going to do is I'm going to put the playlist for this class in the chat if you're watching live. Otherwise, you can just go to the playlist on the Trader Talks channel. Remember to subscribe to that. And you'll see last week's session, and I can't remember what the title was, but it had something to do with in the money or out of the money, which is better or something. Well, I'll give you a hint. There's not a better, but there's pros and cons to both there. Okay. Now, Dennis said, is open interest a factor? Yeah, open interest is a factor you can look at for this. I kind of gave you a little shortcut here on this in terms of the bid-ask spread of looking for liquidity there. But you can also go up to here, you can go up to open interest, and open interest, this column right here is going to tell you how many open contracts there are of these for each of these strikes. We have quite a few on each of these. Now, there's a kind of a correlation between those. The higher open interest, typically the tighter your bid-ask spread. Now, sometimes I get asked, what about option volume? I don't even look at the option volume there. I care much more about the bid-ask spread and the open interest than I do the option volume. That option volume is just how many have traded today on this, not how many are overall out there on this. So there we go. So let's go and let's buy this. And I'm going to put a stop on it though. So I'm going to right click on this. I'm going to buy custom with a stop. So here we go. I have this trade. I'm buying out the April 17th contract, giving us a little bit more time on this. It's going to cost us about $12. Okay. Net mid price is about $11.95, so we're probably not going to get any better than that. If there is a bigger difference between these two, you may try and adjust this price to in between the natural price and the bid price and try and get somewhere in between those two. But these are pretty tight, so I'm just going to leave it as is. So let's do this. I'm going to change my stop price to good till canceled. Now, what's the difference between this? Okay, what's the difference between this and the last order we did? Remember the last one, we triggered our exit based on the stock price. In this case, what I'm going to do is I'm going to trigger my exit based on the option price. If I'm buying this for around $12, here's what I'm going to do. I'm going to put in an order to sell for about 70% of that. 70% of 12 is $8.40. So I'm going to put this price in at $8.40. Now, some of you who are stock traders and used to the stock trading realm are going, that's a pretty big stop, pretty good gap. 30% below the current price for a stop seems excessively big, Brent. That's actually maybe even on the tight end of things here for us. Options are more volatile. They bounce around more, which is why they're a little more risky in that regard. So that's about a 30% stop loss beneath this price. I just went 0.7 times 12. It's actually, I could have done 11.90. Good till canceled. Now notice, I don't have a target price on there. I could, if I wanted to, I could put in a limit sell order to sell out if this stock hits, if this option hits $18 or something like that. That would absolutely be totally legitimate. But my theory on this trade right now is this is a trade, and I'm just going to let it run as long as it continues to go down. Now, if the stock progresses down and our option is making money, then what I may do is I may move up that stop loss along the way. And remember, stops aren't guaranteed. This price could go to zero overnight, okay? So there we go. Now, SBHA 30 said, how do you tie that to the option, to the stock price? I showed you guys that earlier on the last trade. To tie it to the option price, what we did was we went to this gear over here. I'm not going to go into that right now, but just as a refresher, I went to this gear over there to tie it into the option price there. In this case, this is a stop. Remember, we did a market order. In this case, it's a stop order. 840 I'm going to click on confirm and send. And then what I'm going to do is, now you can choose what, if you have different groups, what to put in. Okay. And I'm going to put this in my long single options group. I should have done that with the other one. I'll move that one later. In fact, that other one, that other trade we did, which was UNH, if you want to change the group after, you can just simply right click on it, move to group. It's going to be my long single options group there. Okay. That's options, guys. Those are the three key elements I want you to pay attention to as that I think are essential for every option trader. No, as I mentioned in the beginning, it's not just long option traders, short option traders. You want to sell a short put? You should be aware the P, the price, the time, the volatility, the delta, the theta, the vega of those trades, but they're kind of a key foundational concept. We also talked about not just what these are, but we talked about ways to perhaps kind of minimize how the detrimental effects of theta on that trade. Remember, we're going to buy out a little bit farther. We're going to exit. We're not going to hold it for longer than we need necessarily, because over time that theta will work against us there. And remember, with volatility, it is beneficial, not that you can always be, it may not always be the prime concern, but it can be beneficial to if you're going to buy a call or buy a put, to buy when that implied volatility is low and you think that implied volatility is going to go up. So we did 2 example trades today. We did one on UNH, United Health Group. We did one on AMD. We did one long put example. We did one short, long call example. And there we go. Now, just a reminder, you can follow us on X, Twitter. Both Connie and myself put out extra content each day on X, at Brent Moore CS, at Connie Hill CS. Also, subscribe to the Trader Talks channel. And if you liked what you got today, please just click on that like button at the bottom of the page there. We do appreciate that. It helps us out. It helps us to spread this message, this free education we give people. It rewards us in that sense for free education. And but if you do subscribe to this channel, you're more likely to see both this class and other classes going forward here on your YouTube feed. Coming up next, we have Getting Started with Technical Analysis. Thank you, everybody, for joining me today, and we will see you all same time next week. Bye-bye.